If you're in the military and you want to stop paying taxes because you realize how awesome it is to have BAH coming in tax-free, then listen up, because I'm going to give you the framework on how to legitimately, legally not pay taxes at all. And it's a pretty gosh darn simple framework, and it'll also help you retire way better. I want to show you a framework on how you can not only transition better, but also just stop paying taxes. Be done with taxes. What's up, everybody? Mark Yancich here with Active Duty Passive Income, the premier place where all military families can learn how to invest in real estate and become entrepreneurs and, live a better life for the country that they served. So, all right. When it comes to taxes, here's one little nugget I want to give you before we jump into this, because you're probably wondering, why the heck is this even a thing? Well, because the government could have made it very easy on themselves. They could have said, hey, if you make this amount of money, you pay this percentage of taxes. But no, they decided to write thousands of pages of tax code that would actually serve as a guide for how to not pay taxes. That sounds crazy, but that's actually why the IRS tax code is written. It's a rule book, how to not pay taxes. Because somebody once realized that for a government to be able to incentivize its people well and to have them actually do the things that the government wants them to do for it, the government, the country, is basically say, here's some tax breaks. Because what they realize is people actually hate paying taxes more than they just hate not making as much money. They would rather make less money than have to pay the government any money that they make themselves. And so here we go. All right, so step number one in the don't pay taxes framework is buy a rental property. If you want help with this, hit up the links below. Active Duty Passive Income is partnered with some amazing people that'll help you get rental properties, also turnkey rental properties if you don't want to do any of the renovations. So check that out. But if you get a cash flowing rental property, what that'll do for you is it'll create you income. And then it'll also do another cool thing, which is called depreciation, which is step 2. All rental properties are considered capital assets that you can depreciate over time because the government considers them having wear and tear over time. These long-term capital assets you get to depreciate instead of deduct over multiple years. And in real estate, that happens to be 27 and a half years. So you take the property's value minus the land and you divide it by 27 and a half, and that amount you take as a loss or as an expense, as a deduction against the income it produced. So if you made $2,000 in cash flow from a property, but the depreciation was $2,500, you're actually in a $500 loss on paper, even though you actually put the $2,000 in your pocket. So what you do is you depreciate that property, and so that income that you're making, you're actually putting into your pocket tax-free. Now, for step number 3, here's what you do. You have a fork in the road. There's gonna be a moment in time when you own this property long enough to where either it's gonna appreciate enough in value to where you have a lot of value, or what's called equity in the property, meaning hey, let's say it was a $200,000 property, and then it became a $400,000 property, and let's say your loan, instead of being 100 whatever thousand it was, maybe it's only 50,000. So now you have a $400,000 house, $50,000 in debt. That difference is $350,000. That's called equity. That's money you have in your pocket. What if the property isn't producing that much monthly cash flow compared to that amount of equity that you have in it? That might be a decision point that you're you know what, I'm gonna sell this thing, then buy more rental properties because with that equity, because I know that I can create more wealth, I can create more cash flow with that equity. So that's one decision point. Or what you might realize is that the rents start going up so much because of inflation or whatever, demand in that area, that you'll actually be making more money every month than you're able to depreciate. So you start paying a little bit of taxes on that income. So when you get to that point where you see either there's a lot of value equity in the property or your rental profits are higher than the depreciation on an annual basis, then you come to this decision, right? Okay, so those are the two things you got to look out for. You can either sell the property and take all of the proceeds, not only the profits, any money you get out of that sale, you got to roll it into another property or multiple properties so you can scale your portfolio, or you go to the bank and you're hey, I want a fresh loan on this, which is called a refinance, which is also known as, if you're pulling cash out, a cash out refinance. Basically, it's just a fancy way to say, hey, I'm gonna sell the property to myself at a higher price. So I'm gonna get a fresh loan that's way bigger than the one I had. I use that fresh amount of debt that the bank's gonna write the check to me, right? Because I'm selling it to myself. And I'm gonna pay off the old loan, and whatever's remaining is cash. And it's tax-free because it's not income. It's debt. Debt is tax-free, always. So you now have a pot of cash that is tax-free. Your cash flow, so your profits on that property are going down every month compared to what they used to be, because now the debt payments every single month, right? The mortgage is higher than it was. But now maybe that depreciation is, again, completely wiping out your cash flow that you have in that property coming to you every single month. So now all of a sudden, you kind of recalibrated the cash flow, like the profit and depreciation balance, and you pulled out a lot of tax-free cash, which you can go buy more rental properties with, and now you can scale your portfolio that way. So like I said, there's two potential trigger points and then two potential paths you can take, a fork in the road, if you will. So let's just go over that one more time before I keep moving. It's either there's more equity in the property than before, and there's so much, in fact, that you know that you could be making more money elsewhere. You got to think about making your money work for you. Or the rents are so high now in that property that the depreciation isn't quite doing what you hoped it would do, and you want to figure out how to scale from there, right? So let's say you're doing this smartly, right? You're doing everything I just talked about. You're buying rental properties, you're depreciating them, and then you're cash out refinancing them or doing 1031 exchanges for like kind properties, and you're scaling your portfolio and you're like, this is awesome. Well, guess what's eventually going to happen is eventually you're going to be like, hey, what if I would like to take a loss against some other pot of money I'm making elsewhere? Or what if my spouse is making a W-2 over here and I want to not pay taxes on that either? What if I'm still in the military and I have a W-2 and I don't want to pay taxes on it? Well, either you or your spouse can do what's called becoming a real estate professional. This doesn't necessarily mean you have a license like a real estate agent or a loan officer. What this means is you spend a certain amount of time, and there's a couple of the nuances I'm not going to go over in this video, but it's pretty simple. You just qualify based off of how much you spend dealing with real estate. And all of a sudden, after you meet those certain marks, one of them is 750 hours in a year is what you have to be spending, on real estate activities. Once you qualify, the IRS is like, all right, now you get to claim unlimited losses against your active income as well. It's not only passive losses deducting against passive income, it's now also that those passive losses deducting against all of your income. And so this is where things get magical, because you can have a W-2 job potentially, or your spouse can if you're married filing jointly, and you're not paying taxes on your rental income, and then you're also wiping out the taxes on your active income, like your W-2 income, for example. This is where things just get wild, right? Because you realize how beneficial it is to invest in real estate. I mean, the IRS tax code literally prefers Americans invest in real estate almost above any other activity when it comes to tax benefits. Whew, I know that was a lot, but that is the framework. Okay, that is what you do if you don't want to pay taxes. You buy rental properties, you depreciate them, you do 1031 exchanges and cash out refinances, and then you or your spouse can become a real estate professional. And you're virtually going to pay zero taxes. And you're going to have a loss sometimes, but it's okay, because there are ways to still qualify for other loans. There are ways to become, to still have purchasing power in America, even though some people are worried about that. That all becomes negligible, and you're not going to have to worry about it once you're making that much income that's tax-free. All right, Mark Jan Sitch with Active Duty Passive Income is out. See you later.